Guys, I'm John Fryer. Welcome to Fryer Funds and welcome to my kitchen. Before I get started, of course, not financial advice, not legal advice. Consult your own advisors and make your own decisions. But with that, let's kind of go into this. So all I'm doing here is documenting something I recently did to incorporate options into my investing. Options are something that are new to me relatively. I've only been doing it for a few months. But I wanted to release a video to give you an idea of kind of what I'm doing to incorporate it with my investing. So what is a stock option? You've probably heard the term, but don't know what it is. So the easiest explanation I can come up with here. It's an agreement to buy or to sell 100 shares of a stock. And in that agreement, there's a price and there's an expiration date. So you're agreeing to either buy or sell 100 shares at the given price by the given date. So I'm looking at selling options with my investing. So what I'm doing is I'll sell a call option to agree to sell 100 shares of a stock at a price. Or I'm selling put options, is what they call it, to agree to buy 100 shares of a stock at a price by a date. So with this, I'm trying to get 1% per week on average based on the initial investment I made in capital. Either with the put or the call. So let's get into one that I've done over the last few weeks and where it's at today so I can kind of show you what I'm talking about. So on July 22nd, I sold a put option agreeing to buy 100 shares of NCLH, which is a cruise line, one of the cruise lines that have crashed with the pandemic going on. Agreed to buy 100 shares of them at $14 by July 22nd if the stock price was, of course, lower than that. If it's higher than that, then they wouldn't want to sell it to me at $14, so they wouldn't. But have me buy it at $14 a share. Yeah, they wouldn't want to sell it. So I collected $44 for this, giving me a 3.1% return on the $1,400 it would take. So that's my initial. That's how much collateral you have to buy 100 shares at $14 a share. I have to have $1,400, right? So I collected $44, which is a 3.1% return for the week and a half. So that's not so bad. Well, on July 31st, the stock had gone below $14, so I had to buy it at $14. So net loss technically because the stock was trading at, I think, $13.50 on Friday, and so I had to buy 100 shares at $14, but I collected the $44 up front, and then I had 100 shares of NCLH. Now, on that next Monday, I sold a call option agreeing to sell the 100 shares that I have at $14.50 a share on Friday. So it's a 1-week expiration. And I collected $18 to sell this option. So if on Friday the share price of NCLH is over $14.50, I have to sell it at $14.50, but I collected $18 up front to do that. Now, I originally bought it at $14, so there'd still be profit in there for me. But if it's above $14.50, I could lose out. But the $18 is a 1.3% return on the original $1,400 I put into it, right? So 1 week, 1.3%, not bad. That's my goal. And then on the 7th, that Friday, NCLH wasn't above $14.50. I think it was right around $14. So I kept the 100 shares, contract expired. I kept the $18 and moved on to the next week. So here it is the next week on Monday, August 10th. Today is August 11th. So I sold another call option, expiring this coming Friday, August 14th, at a $17 a share strike price. So if NCLH is up to $17 by the end of the week, I'll sell it for $17, and I collected $17 up front to do that. So remember, I originally bought it at $14. If on Friday it's up to $17, I'd sell it at $17, collecting that $300, plus the $17 I already sold, and then the other premiums I had already collected. And that $17 is 1.2% on that $1,400 initial investment into it. Well, Tuesday, which is today, August 11th, NCLH went up to almost $17 already. And I was afraid that by Friday it could go up significantly more, so I didn't really want to stay in that contract and ended up selling it on Friday for $17. If it's trading at like 20, 30, who knows how much this spike's going to be. I don't think it'll be 30 by any means, or even 20 really, but it did get to almost 17. So what I did is I closed that contract, but it cost me $26. So that $17 I initially collected didn't even cover what I had to pay to close that contract or to buy it back. But I was able to then sell the September 11th option for an 1850 strike price, collecting $97. So altogether, I collected $61 to roll this over at a further strike at a further date. So that gave me $15.25 on average per week going forward. So this week I already covered. So the next 4 weeks till September 11th after this, I'm still collecting on average $15.25 a week, or just over the 1% for those 4 weeks, because 1% would be $14 on the dot. So if, as we go closer to September 11th, if NCLH gets up to 1850, I can roll that over, buy it back and close it, and sell another one at a further strike, probably at a further date, to collect on average $14 a week, or just 1% per week, which is my goal. And I'll continue to do that until I get to the point that either I can't continue to sell options at $14 a week on average, or I decide NCLH isn't the right investment. I want to take the money that's invested in there, sell it off with where it's at, and invest it into something else. So overall, thus far, I've collected $140, 7.5 weeks worth, giving me just over 1%. I think it's 1.1% on average per week. But yeah, as long as I can continue to sell call options with these 100 shares that I now own, I will, collecting more and more premium as time goes on, as well as the stock going up, because I think it will. I was investing in this anyway, right? I wouldn't do this with a stock I didn't want to own, I didn't want to invest in. I do want to invest in the cruise lines. If you're following the Friar Feast, this is one of the stocks in there. I'm doing this with a few others, but this is just the one I wanted to use the example with. So yeah, that's how I'm incorporating options. So I'm agreeing to sell the stock at a price, collecting money up front, and then if it gets close to that price and I don't actually want to sell it, I'll just close that contract, buy it back, and sell a different one at a further strike down the line, collecting more money, as long as my average per week is 1% per week based on the option contract. But that's all I have for you today. I will release more videos on options down the road as more things kind of happen, but that's an introduction, and hopefully we'll incorporate this in the Friar Feast when it gets big enough that we can buy 100 shares of a single stock without it over flooding the percentage of our portfolio. But that's all I've got for you guys today. Again, not financial advice, not legal advice. Consult your own advisors, make your own decisions, and I'll see you next time.